All right, so let's talk about Robinhood. You've definitely seen the ads, right? Zero commission trading. It sounds amazing, like you're getting something for nothing. But you know what they say, if something's free, you are often the product. And today, we're going to pull back the curtain and see just how complicated that word free really is.
Okay, so here's the big question, the puzzle at the heart of it all. If you're not paying a fee, not a single penny in commission, then how on earth does a company like Robinhood make its money? I mean, they're a massive public company. They have to be turning a profit somehow, right? So where's the cash coming from?
All right, the big secret, the main engine behind this whole thing, has a fancy name: payment for order flow. People just call it PFOF. Now, I know, it sounds like some super complex Wall Street jargon, but trust me, the basic idea is actually pretty straightforward once we unpack it.
So get this. The crucial thing to understand is that when you place a trade on Robinhood, you're the customer, yeah? But your order is actually the product they're selling. Robinhood's real business isn't just executing your trade, it's selling the opportunity to execute your trade to the highest bidder.
This is a really great way to picture it. Think of Robinhood as the sales department of a giant bank. Their job is to go out and just bring in a fire hose of customer orders, millions of them. Then you have the market makers. These are the huge firms like Citadel Securities. They're the trading department. They're the ones who actually do the work, executing all the business that the sales team brings in.
Okay, so let's follow the money, right? The second you tap buy on that stock, boom, your order is instantly routed and sold to a market maker. That firm then executes the trade for you, and in return for getting your business, they pay Robinhood a little rebate, like a kickback. And this isn't happening slowly. We're talking about a process that takes milliseconds and happens millions and millions of times every single day.
Now this is where it gets really interesting, because Robinhood realized something incredibly clever. Not all trades are created equal. In fact, what you're trading makes a massive difference to their bottom line. Some orders are just way more profitable for them than others.
So you might be wondering, okay, but how can these market makers afford to pay Robinhood? Well, the profit is hidden in the price you get. It's tiny, but it's there. They might buy the stock for you at, say, $100.01 when the absolute best price was $100.01. That tiny difference, that's called slippage. It's a fraction of a penny. But multiply that by millions of trades, and you're talking about a ton of money.
And this number right here, 55 basis points. This is the golden ticket. This unlocks everything about Robinhood's strategy. So a basis point is just 1/100%. It means for every dollar's worth of crypto you trade, Robinhood is making about 55/100%. I know, that sounds ridiculously small, but just you wait. The comparison is going to blow your mind.
And bam, here it is. This is the big reveal. Look at that difference. Trading crypto is over 60 times more profitable for Robinhood than trading a regular stock. 60 times! And it's almost 7 times better than options. This huge gap, this is the real secret sauce. It's the reason their whole business is tilted towards getting you to trade crypto.
So where does that 55 basis points actually come from? Well, most of it, about 35 points, is that direct rebate we talked about from the market makers. But they squeeze out another 20 points from other stuff, like smart routing and that little bit of price slippage. What's crazy is that all in, it's nearly half of what an exchange like Coinbase just charges you up front. But since you don't see the fee, it feels completely free.
Okay, so when you see profit margins that are 60 times higher on one product, what do? You try to make everything that product. And that's exactly what Robinhood's doing. This huge profit gap is why they're now making this massive push to bring that lucrative crypto model over to the regular stock market. And we're seeing the first big move with their launch in Europe.
The product they've created is called stock tokens. And the idea is really simple, but really powerful. What if you could trade something that acts just like a share of Tesla, but it trades 24/7, and most importantly, it uses the same back-end system that makes crypto so incredibly profitable for them? But, and this is a big but, Robinhood is playing it very smart, very carefully. They didn't create a real on-chain token that you can withdraw to your own wallet. That's what a competitor like Kraken is trying to do. No, Robinhood created a derivative. It's a closed system, a walled garden. You get the financial exposure to the stock's price, but you don't actually own it and you can't move it. It's a super clever move to get around regulations while still building out this model.
And this quote right here, it just lays it all out. This is the end game. The big ambition is to eventually get all trading, stocks, ETFs, the whole shebang, to work just like crypto trading does now. Why?
because the profit margin is just dozens of times higher. It's a complete transformation of their business model.
But here's the thing. A model this profitable, this opaque, well, it doesn't come for free. There are some serious questions and major risks involved. And as we're about to see, this system has already been at the heart of one of the biggest market controversies in recent memory.
And here's why this is such a big deal. The United States is kind of an outlier here. The European Union, the UK, Canada, Australia, they've all banned payment for order flow for stocks. And the reason is simple. It creates a massive conflict of interest. Think about it. Is your broker really trying to get you the best price, or are they just sending your order to whichever firm pays them the biggest fee? In the US, it's still allowed, but that debate is getting louder and louder.
And if you want a perfect example of how this can go wrong, look no further than the GameStop saga. The whole financial system runs on this old, clunky plumbing where it takes 2 whole days for a trade to actually settle. When GameStop stock went absolutely parabolic, the central clearinghouse, the folks in the middle, panicked. They looked at the risk and told Robinhood, "You need to give us $3.7 billion in cash right now as collateral." Robinhood only had about $700 million. They couldn't pay, so they had no choice but to pull the emergency brake and halt all buying.
And this is exactly why you hear so much buzz about putting everything on-chain. Because with blockchain, you don't have that 2-day lag. A trade can settle pretty much instantly. If that technology had been in place, the whole GameStop settlement crisis might never have happened. That risk that caused the trading halt, it could just disappear.
So we're going to leave you with this question to chew on. Now that you've seen behind the curtain, you know about the hidden fees, the conflicts of interest, and the huge ambition to transform the market, what's your take? Is free trading really a game changer for the little guy? Or is free just a much nicer way of saying a cost that's been hidden from you?